In January 2019, a company called WeWork was valued at $47 billion. Let that sink in. $47 billion. It was the most valuable real estate company in the world, except it didn't own any real estate. It was the most valuable startup in the United States, except it had never turned a profit. It was run by a man named Adam Neumann, a 6'5" Israeli former naval officer with a magnetic personality, a talent for fundraising, and a business model that, when you examined it closely, made almost no sense. 18 months later, that $47 billion valuation had collapsed to approximately $3 billion. The CEO was gone, the IPO was dead. SoftBank, the Japanese conglomerate that had poured over $10 billion into the company, was writing off 90% of its investment. The public had seen the company's financials for the first time, the S-1 filing that revealed $47 billion in future lease obligations against only $4 billion in committed revenue, and the market had responded with a collective, horrified no. To understand how a company could lose $44 billion in value in under 2 years, you have to understand that WeWork was never really a real estate company at all. It was a story, a very well-told story, backed by billions of dollars, promoted by one of the most charismatic founders in modern business history. And when the story stopped working, the numbers told a very different truth. This is the story of how WeWork went from zero to $47 billion and back to near zero faster than any company of its size in modern history. It is a story about a charismatic founder who convinced the world he was a genius. It is a story about the largest venture capital firm on the planet making the single biggest bet in the history of venture capital and losing almost all of it. It is a story about a business model that was, in the words of one analyst, a technology company that put a tech valuation on a real estate business. But most of all, it is a story about how we keep mistiming, revenue for profit, story for substance, and how, when the story stops working, the numbers don't lie. The story of WeWork is the story of every bubble, every hype cycle, every time we convince ourselves that this time is different, when in fact, it never is. And the most sobering part is that the system that created WeWork has not changed. The next WeWork is already being funded. Think about what that means. WeWork was not a one-off, a fluke, an anomaly that could never happen again. It was the logical endpoint of a system that rewards growth above all else, that values narrative over numbers, that treats due diligence as optional when the founder is charismatic enough. The venture capital ecosystem that produced WeWork is the same ecosystem that is currently funding hundreds of startups with similarly questionable unit economics. The only difference is that those companies have not yet been forced to disclose their numbers to the public. The S1 is the great equalizer, the moment when the story must confront the spreadsheet. Until that moment, every startup with a charismatic founder and a compelling pitch can hide behind the shield of private market valuations. And the private market, as WeWork proved, can be wrong for a very long time before reality catches up. The question is not whether the next WeWork will happen. It is whether we will recognize it before it costs investors another $40 billion. Adam Neumann was born in 1979 in Tel Aviv, Israel. His parents divorced when he was 7, and he grew up living with his mother and his sister in a series of small apartments. Money was tight. His mother worked multiple jobs. His father, who had been a medical doctor, was largely absent from his life. The experience of growing up with financial uncertainty would shape Neumann's adult behavior in ways that became impossible to ignore later. Those who knew him as a child described someone driven not by a vision of building something great, but by a deep fear of ever being poor again. This fear would become the engine of his ambition, and eventually, the source of his downfall. He was not a particularly good student. He was, by his own admission, restless, unfocused, and easily bored. In school, he was known more for his height and his charm than for his grades. Teachers described him as someone who could talk his way into or out of anything. He had an extraordinary gift. He could make people believe in him. He was tall, charismatic, and relentlessly optimistic. When Adam Neumann walked into a room, people wanted to be in his orbit. He had what some call the founder gene, an almost supernatural ability to make the improbable seem inevitable, to make investors feel like they were getting in on the ground floor of something historic. At 22, Neumann joined the Israeli Navy, serving as an officer. The experience was transformative. He learned discipline, leadership, and how to project authority. He later said that the Navy taught him that the key to leadership was conviction. If you believed in something strongly enough, other people would believe in it too. And Adam Neumann always believed strongly. He also learned something else: how to read people. In the Navy, the ability to assess someone's intentions quickly could be the difference between safety and danger. Neumann developed a finely tuned instinct for what people wanted to hear, and he gave it to them. This skill would serve him well in boardrooms across the world. But the Navy also taught him something darker: how to survive in a rigid hierarchy by mastering its unwritten rules. Neumann learned that in any system, power flows to those who understand how it works, not necessarily those who follow the rules. He would later apply this lesson to venture capital with devastating effectiveness. The venture capital system has its own unwritten rules. Growth is everything. Charisma opens doors, and the last round's valuation becomes the floor for the next. Neumann understood these rules intuitively, and he exploited them with the precision of a military strategist. The $47 billion valuation was not the result of a fraud or a mistake. It was the result of a founder who understood the game better than the people who were supposed to be playing it against him. After completing his naval service, Neumann moved to New York City. He enrolled at Baruch College to study business, but he never graduated. The classroom was too slow for him. He wanted to build things, not study them. In 2001, he started his first company, Crawlers, a baby clothing line that sold pants with reinforced knees so crawling babies wouldn't wear through them. It was a clever idea, born from Neumann's own experience as a new father. He sold the company after a few years for a modest profit. Then came another venture, a high-heeled shoe with a removable sole and a foldable hinge, designed for women who wanted to commute in comfort and arrive in style. The product was called the Second Floor. It was not a success. Neumann lost money. He was 30 years old, living in a rented apartment in Brooklyn, and his startup career had produced 2 failed companies. Most people at that point would have given up. Adam Neumann saw it as preparation. Every failure, he would later say, taught him something. The baby clothing company taught him about customer needs. The shoe company taught him about the gap between a good idea and a viable business. Neither lesson would fully take root. But something else was happening during these early years, something that would prove more important than any business experience. Neumann was building a network. He was meeting people in New York's startup scene, attending the same events, drinking at the same bars, speaking the same language of disruption and innovation. He was learning to perform the role of the visionary founder, and he was a natural performer. The people he met during this period included venture capitalists, real estate developers, and fellow entrepreneurs who would later become his earliest investors. They did not invest in his baby clothing company or his foldable heel, they invested in him. And when the right idea finally came along, the co-working concept that would become WeWork, his network was ready. The lesson, if there is one, is that entrepreneurship is not always about the idea. Sometimes it is about the person. And Adam Neumann was a person people wanted to believe in, even when the evidence suggested they should not. In 2008, Neumann met Miguel McKelvey, an American architect who had been working at a design firm in New York. McKelvey was quiet, analytical, and detail-oriented, the perfect counterbalance to Neumann's explosive charisma. The two of them shared a problem. They were paying too much for office space. McKelvey had an idea. What if they rented a large space, subdivided it, and sublet the extra desks to other freelancers and startups? They found a building in Brooklyn, a former warehouse with exposed brick walls, concrete floors, and the kind of raw, unfinished aesthetic that was becoming fashionable. They called it Green Desk, an eco-friendly co-working space with recycled furniture and energy-efficient lighting. The concept was simple. Rent a desk by the month, with no long-term commitment, and get coffee and Wi-Fi included. It was not an original idea. Co-working spaces had existed in various forms for years, but Green Desk had something that other spaces lacked: Adam Neumann's energy. He would stand at the entrance every morning, greeting people by name, making them feel like they were part of something bigger than a desk rental. He called it a community, and people believed him because Neumann himself believed it. That was the secret to his power. He was not selling a product. He was selling belonging. In 2010, Neumann and McKelvey rebranded Green Desk as WeWork. The name was supposed to convey community, collaboration, collectivism. We instead of me. It was brilliant branding. The first WeWork location opened in April 2011 in SoHo, Manhattan. It had 30,000 square feet of space. It was filled with young startups, freelancers, and small businesses who wanted to feel like they were part of something happening. The design was intentional: exposed brick, polished concrete floors, open ceilings, glass-walled conference rooms. It looked like a movie set of an innovative tech company. That was the point. Every element was designed to signal that this was not an office. It was a lifestyle, an identity, a badge of belonging to the startup economy. The early investors bought in quickly. Manhattan real estate developer Joel Schreiber purchased a 33% stake in the company for $15 million in 2011. The valuation was $45 million. For a company with exactly one location and zero profit, that was an extraordinary price. But Schreiber was not buying a real estate company. He was buying Adam Neumann. He later said, "I met Adam, and within 10 minutes I knew I was in. He has that thing, whatever that thing is. That thing, the charisma, the conviction, the ability to make you feel like you were part of something historic, was worth more to any investor than a balance sheet full of profits. It would become the most expensive intangible asset in venture capital history. And the investors who bought into it would learn a painful lesson about the difference between charisma and competence." By 2013, WeWork had 5 locations. By 2014, 16. By 2015, 45. By 2018, 528 locations in 111 cities across 29 countries. The growth was explosive. WeWork was expanding internationally to London, Tel Aviv, Shanghai, Sao Paulo, Berlin, Sydney, Mexico City. Every new location followed the same formula. Find a building in a trendy neighborhood, sign a 15-year lease, spend millions renovating it to look like a tech startup, then rent the desks to members on a month-to-month basis. The margins on a fully occupied building could be 30% or higher. The problem, of course, was that most buildings were never fully occupied. The growth created a powerful narrative. If WeWork was expanding faster than any real estate company in history, it must be because the model was working. Every new location opening was accompanied by press releases, social media posts, and CEO pronouncements about changing the way the world works. Members felt like they were part of a movement. Landlords felt like they were partnering with the future. Employees felt like they were building something important. And investors felt like they were getting in early on the next Google. The narrative was so powerful that it became self-sustaining for a while. But narratives, unlike businesses, have no P&L statement. This is where the WeWork story intersects with a broader historical pattern, the narrative-driven company. In every major economic bubble of the past century, from the railway mania of the 1840s to the dot-com bubble of the late 1990s, there have been companies whose valuations were driven not by their financials but by the power of their story. WeWork was merely the most extreme example of this phenomenon in the modern era. The company's internal culture reinforced the narrative at every level. Employees were called team members. The annual retreat was called summer camp, not a corporate offsite. The mission statement, carved in wood and hung in every lobby, read, "To create a world where people work to make a life, not just a living." These were not coincidences. They were deliberate choices designed to make WeWork feel like a movement. And movements, unlike companies, do not need to show a profit. They need believers. And WeWork had thousands of them, from the newest member to the most senior investor. The tragedy of WeWork is not that the believers were wrong. It is that they were right about the feeling and wrong about the business. And the business, in the end, is what matters. But here is the structural flaw, and it is the most important thing to understand about WeWork. The margins only worked if the building was fully occupied. WeWork's fixed costs, the rent it paid to landlords, were locked in for 15 years. If occupancy dropped below about 80%, the building lost money. If it dropped below 60%, the losses were enormous. And because WeWork was growing so fast, it was constantly opening new buildings that took months or years to reach full occupancy. The company was bleeding cash on every new location while it ramped up. This is what is known in finance as a scaling problem. The faster you grow, the more money you lose. By 2018, the company had 527,000 memberships, including 38% of the global Fortune 500. The membership numbers were impressive. But the number that mattered was hidden in the footnote. The average member stayed for 15 months. WeWork's average lease was 15 years. The company's revenue depended on a constant churn of new members replacing the ones who left. In good economic times, the churn was manageable. In a recession, the churn could destroy the entire business in months. It was a business model that worked perfectly, until it didn't. This mismatch, 15-month members on 15-year leases, was the ticking time bomb at the heart of the WeWork business model. To understand why, consider the math at a single typical location. A WeWork building in a major city might cost $5 million per year in rent, property taxes, and building operating costs. At full occupancy, with 500 desks rented at an average of $800 per month, the revenue would be roughly $4.8 million per year. Below 80% occupancy, the building would lose money. Below 60%, the losses would be catastrophic. Now multiply this across 528 locations, each with its own break-even point, each locked into a 15-year lease, and each dependent on a volatile mix of freelancers, startups, and small businesses, the very entities most likely to cut costs in a downturn. The business was not just risky, it was structurally designed to fail in any economic environment other than perpetual boom. And yet investors valued it at $47 billion. The gap between the valuation and the risk was not a miscalculation. It was a suspension of disbelief so complete that it bordered on collective delusion. The business model, lease arbitrage, worked like this. WeWork would sign a lease with a landlord for 15 years at a fixed rate. Then it would rent the space to members on a month-to-month basis. In good times, the short-term members paid more than the long-term lease cost, and WeWork pocketed the difference. In bad times, a recession, a pandemic, a downturn in the startup economy, members would cancel their memberships with 30 days' notice, but WeWork would still be on the hook for 15 years of rent. Every building was a bet that the economy would never have a bad month, and the company had hundreds of these bets. No landlord in the world would take that risk. But WeWork, backed by SoftBank's billions, thought it was different. Adam Neumann described the model differently. He called WeWork a technology company and a community platform and a social network for physical space. He said that WeWork was not in the real estate business. It was in the business of elevating the world's consciousness. At a company retreat in 2015, Neumann stood on stage in front of thousands of employees and explained, "Your net worth is not your self-worth. WeWork is a community. We are here to make a difference." Employees cheered, investors cheered. In the actual business, the 15-year leases and month-to-month memberships continued to lose more money every single year. The disconnect between the rhetoric and the reality was not a bug. It was the entire business model. In 2014, WeWork had raised about $500 million. By 2016, the company had raised roughly $1.4 billion from investors, including Fidelity, JP Morgan Chase, and Benchmark. The valuations climbed, $5 billion, then $10 billion, then $16 billion. Wall Street had decided that WeWork was not a real estate company. It was a technology platform that happened to rent desks, and technology platforms deserve high valuations. The logic was circular but persuasive. If WeWork was valued like a tech company, it must be a tech company. Nobody stopped to ask what the actual difference was between renting a desk and being a technology platform. The answer, as it turned out, was nothing. In March 2016, WeWork raised $430 million from Legend Holdings and Honey Capital at a $16 billion valuation. The company was now worth more than some of the landlords it rented from. It was worth more than most publicly traded real estate companies, and it had still never turned a profit. By every traditional measure, profit, cash flow, return on capital, WeWork was a failing business. But traditional measures had been abandoned. In the new economy, growth was the only metric that mattered, and WeWork had growth. The psychology of these investors is worth examining. Legend Holdings and Honey Capital are not naive retail traders. They are sophisticated institutional investors with teams of analysts who spend their days scrutinizing balance sheets. And yet, when they looked at WeWork, they saw what everyone else saw: momentum. The $16 billion valuation was not based on discounted cash flow analysis or comparable company multiples. It was based on a simple, seductive premise. If WeWork keeps growing at this rate, it will eventually be worth more than $16 billion. The logic was tautological. The company is worth this much because it might someday be worth more, but it was enough to write the checks. This is the logic of greater fool theory dressed up in venture capital clothing. Every investor who bought into WeWork did so believing there would be a greater fool to buy at a higher price. The problem, as we will see, is that the greatest fool turned out to be the one writing the biggest check, Masayoshi Son. Masayoshi Son is the founder and CEO of SoftBank, a Japanese technology conglomerate worth over $100 billion. In 2016, Sun launched the SoftBank Vision Fund, the largest technology investment fund in history. $100 billion raised from sovereign wealth funds, pension funds, and some of the world's largest investors. Sun had a theory. The future of the global economy would be built by a small number of companies that achieved massive scale through technology. He called them group companies. He wanted SoftBank to own pieces of all of them. Sun met Adam Neumann for the first time in early 2017. The meeting lasted 30 minutes. Sun later said, "Adam is a genius. He is exactly the kind of founder I want to bet on." Within months, SoftBank had committed $4.4 billion at a $20 billion valuation. It was one of the largest single investments in a private company in history. The speed of the decision was remarkable, 30 minutes to commit billions. It reflected Sun's investing philosophy. Trust your instincts, bet on people, move fast. It also reflected a complete absence of due diligence. SoftBank did not commission an independent audit of WeWork's financials before writing the check. They did not interview the CFO. They did not test the business model against a recession scenario. They trusted Adam Neumann's charisma, and that trust would cost them billions. To understand how this kind of decision-making was possible, you have to understand the structure of the SoftBank Vision Fund. The fund was not Sun's own money. The largest investor was the Public Investment Fund of Saudi Arabia, which contributed $45 billion. Other investors included the Mubadala Investment Company of Abu Dhabi, Apple, Qualcomm, and Foxconn. The fund structure gave SoftBank extraordinary discretion with other people's money. The Saudi Sovereign Wealth Fund, under the direction of Crown Prince Mohammed bin Salman, was looking for transformative investments that aligned with the kingdom's Vision 2030 plan to diversify its economy away from oil. Sun pitched the Vision Fund as a way to gain exposure to the future of technology. The Saudi investors, like most of the fund's limited partners, had limited visibility into the day-to-day investment decisions. They trusted Sun. And Sun trusted Neumann. The chain of trust, Saudi Arabia to SoftBank to WeWork, carried $10 billion down a path with no guardrails. When the investment collapsed, the losses rippled back up that chain, damaging the reputation of SoftBank and raising uncomfortable questions about sovereign wealth fund governance in the process. The world's largest venture capital fund had been defeated by a desk rental company with good lighting and a charismatic CEO. But Masayoshi Son was not done. In January 2019, SoftBank invested another $2 billion at a $47 billion valuation. Total SoftBank investment, over $10 billion. The terms of the deal were extraordinary. SoftBank was buying at a price that implied WeWork would be worth $100 billion within a few years. Sun told Neumann, "In a war, you need to be a little crazy. You are crazy enough. I like crazy." And here is where the story gets strange. Sun and Neumann developed a relationship that went beyond investor and founder. They would take long walks together. They would call each other at 2 a.m. Sun would send Neumann handwritten notes. Neumann referred to Sun as his spiritual father. The $10 billion bet was not based on a financial model. It was based on a feeling. The feeling that Neumann was a visionary, that WeWork was a movement, and that traditional metrics like profit and loss did not apply. This was venture capital as emotional investment, and nobody had ever lost this much money on a feeling before. With $10 billion in the bank, Adam Neumann began spending. He bought a Gulfstream G650 private jet for more than $60 million. He called it the Wingman. WeWork paid for pilots, fuel, maintenance, and hangar storage. Neumann later said the jet was necessary because flying commercial was too inefficient for a CEO who needed to be everywhere at once. The jet was available to Neumann 24/7. Other executives were told to fly commercial. He bought mansions. He bought a $35 million estate in Westchester County. He bought a $21 million compound in the Hamptons. He bought a $10 million apartment in Manhattan's Greenwich Village. He bought a $4.7 million home in San Francisco. WeWork would later lend Neumann $50 million personally, with an interest rate so low it barely covered inflation. The loans were approved by a board that included Neumann, his friend, and executives whose compensation depended on him. It was not illegal, but it revealed something essential about the culture at WeWork. The company existed to serve the founder, not the other way around. The spending was not limited to Neumann. WeWork itself burned through cash at an astonishing rate. The company spent millions on corporate retreats. One retreat, called Summer Camp, was held annually at a private estate in upstate New York. It featured concerts by major artists, open bars, and keynote speeches about consciousness and community. The 2018 summer camp cost $15 million. Employees were told it was an investment in culture. The S-1 filing would later reveal that WeWork spent over $200 million on events and experiences in a single year, more than some Fortune 500 companies spend on research and development. And then there were the side ventures. WeWork was not content to be just a desk rental company. It launched WeLive, a residential co-living venture that rented apartments on a month-to-month basis. It launched WeGrow, a private elementary school. It launched Rise by We, a chain of fitness studios. It launched WeWork Food, a cafe and food service. It launched WeWork Media, powered by Rolling Stone, a content and event partnership with the iconic music magazine. It acquired Meetup, the social networking platform, for $200 million. It acquired a digital marketing agency. It acquired a coding bootcamp. It built a wave pool in its corporate headquarters, an actual wave pool for surfing indoors. None of these ventures were profitable. Most of them were never intended to be profitable. They were designed to support the narrative that WeWork was not a real estate company, but a technology platform and a community movement. The more businesses WeWork launched, the easier it was to tell that story, and the more money it lost. If the business model was questionable, the governance was indefensible. Adam Neumann had structured WeWork so that he had absolute control. He held majority voting power through a dual-class stock structure, meaning he could overrule the board on any decision, any time. He could appoint directors. He could approve his own compensation. He could lend himself money from the company. He could enter into business deals with himself. There were no checks, no balances, no independent oversight. It was not a corporation. It was a monarchy. The S-1 filing revealed a series of related party transactions that stunned even seasoned investors. WeWork's parent company had paid $5.9 million to an entity owned by Adam Neumann for the trademark rights to the word we. Think about that. The CEO's personal company owned the trademark for the company's name, and the company, the one that had borrowed $12 billion from investors, had to buy the name from its own CEO. Neumann later returned the money after the IPO filing made the payment public. But the fact that it was structured that way in the first place told you everything about the culture. The CEO saw the company as an extension of himself, not a separate entity with its own shareholders, directors, and legal obligations. The trademark deal was not a mistake or an oversight. It was a window into how Neumann thought about the company. To him, WeWork was his property, and the investors who had put in billions were merely guests. This was not the only related party transaction. Neumann and his family members were employed by WeWork in various capacities. His wife, Rebecca Neumann, served as the company's chief brand and impact officer and was a member of the board. She was also named as the sole decision-maker for who would replace Adam as CEO in the event of his death or permanent disability, a clause that corporate governance experts described as unprecedented in modern corporate history. Rebecca was a former actress and a follower of the Kabbalah spiritual movement, and she brought her spiritual beliefs into the company's operations. She was instrumental in launching WeGrow, the private school that WeWork operated in Manhattan, where tuition could reach $42,000 per year. The school's curriculum included yoga, meditation, and lessons about how to manifest one's dreams, along with more traditional subjects. The school was emblematic of the blurring of lines between Neumann's personal life and the company's operations, a blurring that was never challenged by the board because the board was designed not to challenge. Neumann had also taken out $500 million in personal loans from banks, using his WeWork stock as collateral. He had cashed out $700 million of his shares before the IPO, selling to existing investors at the $47 billion valuation. The message was clear. The founder who was telling investors the company was worth $47 billion was simultaneously selling his own shares at that price. If he truly believed the company was worth $100 billion, why was he selling? It is one of the oldest warning signs in investing. When the founder starts selling, it is time to ask why. But SoftBank, Fidelity, and the other investors did not ask. They were too busy believing the story. They were too invested in the narrative to question the man at its center. The S-1 filing also revealed that Neumann had personally leased buildings he owned to WeWork. The company was paying rent to a CEO who was simultaneously the landlord. One building in Manhattan was owned by a partnership that Neumann controlled. WeWork was paying above-market rent for the space. Neumann was on both sides of the transaction. This was not illegal, but it was the kind of governance failure that made investors lose trust, and trust, once lost, is very difficult to recover. The S1 was not just a financial disclosure. It was a confession. Page by page, it revealed that WeWork was not a company in any conventional sense. It was a vehicle designed to enrich its founder, with investors as unwitting passengers. The board of directors was equally problematic. Of the 7 board members, 3 were appointed by SoftBank. 2 were Neumann's personal associates. 1 was a friend from his real estate days. The board met rarely. It approved the related party transactions. It did not question the spending. It did not demand a plan for profitability. The board's job was to advise and oversee, but Adam Neumann had structured the company so that the board had no real power. He was the king, and the courtiers were paid to agree with him. When the S1 finally revealed the board's composition, corporate governance experts were horrified. This was not a board of directors. It was a collection of people whose primary qualification was loyalty to Adam Neumann. And loyalty, in a corporate boardroom, is not a substitute for independent judgment. It is, in fact, the opposite of what a board is supposed to provide. A board's job is to challenge the CEO, not to cheerlead for him. WeWork's board had forgotten this fundamental principle, and it cost investors billions. To put this in perspective, most publicly traded companies are required by stock exchange rules to have a majority of independent directors, people with no material relationship to the company or its management. WeWork, as a private company, had no such obligation. But as it prepared to go public, the governance deficiencies became impossible to ignore. The SEC, stock exchanges, and institutional investors all expect a certain standard of governance before they will approve an IPO. The S1 revealed that WeWork failed almost every test. There were no independent committee chairs. The audit committee included directors with financial ties to the company. Key decisions, including Neumann's multi-million-dollar consulting fees and the trademark purchase, had been approved by directors who were not independent. The governance was so flawed that even if the business model had been sound, the IPO might have failed on governance grounds alone. In the end, the business model and the governance both collapsed simultaneously, each amplifying the damage of the other. It was a perfect storm of structural failure, and it had been visible to anyone who looked, if only someone had been looking. On August 14, 2019, WeWork filed its Form S-1 with the Securities and Exchange Commission, the first time the company had ever been required to disclose its full financial details. The document was 311 pages long. It contained everything: revenue, losses, lease obligations, related party transactions, governance structure. And when Wall Street analysts read it, they could not believe what they were seeing. The numbers were catastrophic. WeWork had generated $1.8 billion in revenue in 2018. But its net loss was $1.9 billion, meaning the company lost more money than it made. In the first half of 2019, the trend was accelerating: $1.5 billion in revenue, $900 million in losses. At that rate, the company was running through cash so fast that it would need to raise more money within 18 months just to survive. The business was not just unprofitable, it was anti-profitable. The more it grew, the more money it lost. This is the opposite of a scalable business model, and yet investors had valued it at $47 billion. The S1 revealed something even more troubling. The losses were not a temporary condition that growth would cure. They were structural. Every new location opened increased the company's total losses, because the cost of signing a 15-year lease and renovating a building exceeded the revenue that building would generate in its first 2 to 3 years of operation. The business was designed to lose money. But the single most shocking number in the S1 was buried on page 179. WeWork had $47.2 billion in future minimum lease payment obligations, the rent it was contractually required to pay landlords over the next 15 years. Against that $47.2 billion in obligations, the company had only $4 billion in committed revenue from future membership fees. The gap was $43 billion. Even if WeWork maintained 100% occupancy in every building, an impossibility in a real estate downturn, it would still lose billions of dollars over the life of its leases. To make matters worse, the S1 revealed that WeWork's own revenue projections were based on a growth rate that would never materialize. The company assumed that its membership base would continue to double every year. In 2018, membership had grown 100%. The S1 projected similar growth for 2019 and 2020. In reality, growth was already slowing. The entire valuation of $47 billion was based on an assumption that had already stopped being true. This was not a forecasting error. It was a fundamental disconnect between the story WeWork told and the reality of its business. And now, for the first time, the public could see both side by side. The response was swift and devastating. The largest IPO in American history was canceled within weeks of the filing. The response from Wall Street was brutal. Analysts who had hyped WeWork as a technology platform suddenly realized it was a real estate company with a bad balance sheet. The IPO was postponed. Bloomberg wrote that the S1 laid bare the gulf between the story WeWork told and the numbers it generated. The Wall Street Journal published a series of investigative articles that detailed Neumann's spending, his governance structure, and his increasingly erratic behavior. The valuation cratered. In January 2019, SoftBank had invested at $47 billion. By September 2019, the public market was valuing WeWork at approximately $10 billion. The company had raised $12.8 billion in total funding. It was now worth less than the money it had raised, an extraordinary achievement in value destruction. In the history of startup investing, there has never been a faster destruction of value at this scale. Not in the dot-com bubble. Not in the 2008 financial crisis. WeWork set a record for how quickly billions can vanish when a story stops working. The speed of the collapse was shocking even by Wall Street standards. Approximately $37 billion of valuation vanished in roughly 40 days. That is nearly $1 billion a day. The aftermath of the S1 filing was not just a financial event, it was a cultural reckoning. For years, the technology press had covered WeWork as a visionary company. Business school professors had written case studies about its innovative model. Other startups had been encouraged to emulate its approach to culture and branding. And then, within weeks of the S1 filing, the narrative reversed completely. The same journalists who had celebrated WeWork were now writing exposés. The same business school professors were now teaching it as a cautionary tale. The same investors who had competed to get into funding rounds were now competing to distance themselves from the company. The speed of the reversal was not just about the numbers, it was about a collective loss of faith. The story that had sustained WeWork for 9 years collapsed, not because the facts changed, but because people stopped believing. And in a story-driven business, when the story stops working, nothing else works either. The employees who had drunk the Kool-Aid were suddenly unemployed. The landlords who had signed 15-year leases were suddenly holding worthless contracts. The investors who had written billion-dollar checks were suddenly writing down their investments to near zero. The story had been too good to check until it was too late to fix. On September 24, 2019, Adam Neumann resigned as CEO of WeWork. He had been in control for 9 years. He had built the company from a single Brooklyn co-working space to a global empire. He had raised $12.8 billion from investors. And in the end, he was forced out by the same investors who had enabled him. The board had given him an ultimatum: resign as CEO or lose the company entirely. Neumann chose to leave. The negotiations over his exit were conducted in secrecy over several days. Neumann wanted to keep control. SoftBank wanted him gone. The compromise was a payout so enormous that it would later be investigated by the SEC and the Department of Justice. SoftBank paid Neumann approximately $970 million for his remaining shares. They paid him a $185 million consulting fee for consulting work that he would never actually perform. They agreed to extend him a $500 million line of credit to repay the personal loans he had taken out against his stock. And they agreed to pay him an additional $46 million per year as a non-compete and advisory fee. The total package was extraordinary. It rewarded Neumann with more money after failure than most founders earn in a lifetime of success. To put it in perspective, Neumann's exit package was larger than the entire GDP of some small nations. And it was paid by a company that was, at that very moment, running out of cash. The total payout to Adam Neumann was approximately $1.7 billion. For a founder who had led a company that lost billions of dollars, that had filed the worst S1 in history, that had destroyed $40 billion in shareholder value, The payout was nearly $1.7 billion. Neumann was 40 years old. He was one of the richest people in America, and he had never run a profitable company. The payout was a symptom of the problem. SoftBank had backed Neumann so heavily that they had no leverage. They could not afford to let him walk away because his departure would trigger more chaos. So they bought his silence, they bought his cooperation, they bought his shares at a price that no rational market would have paid. Masayoshi-san later called the WeWork investment his biggest mistake. But the mistake was not investing in WeWork. It was investing in a founder without any guardrails, without any oversight, without any plan for what would happen when the founder's weaknesses became impossible to ignore. SoftBank created the monster, then paid it to go away. The exit package was structured in a way that insulated Neumann from almost any downside. The $500 million line of credit meant that his personal borrowing against WeWork stock, loans he had taken out from banks like JP Morgan and UBS, would be repaid without him having to sell a single share into a falling market. The $185 million consulting fee was structured as a 4-year agreement, meaning Neumann would continue to earn money from WeWork even after he was no longer involved. The non-compete payment of $46 million per year was essentially hush money, a payment to ensure Neumann would not start a competing business or speak publicly about the company's failures. And the $970 million for his remaining shares was paid at a price that implied a valuation far higher than what the public market was offering. The package was, in effect, a bribe, and it worked. Neumann took the money, signed the agreements, and largely disappeared from public view. He did not write a tell-all book. He did not give interviews blaming SoftBank for his downfall. He took his $1.7 billion and he moved on. The cost of buying his silence was, in the context of the $10 billion SoftBank had already lost, a rounding error. And that, perhaps, is the most cynical part of the entire story. On November 6, 2019, less than 2 months after Neumann's departure, SoftBank announced that it was writing down $9.2 billion of its WeWork investment. That is 90% of the total $10.3 billion SoftBank had invested. It was one of the largest write-downs in venture capital history. To put it in perspective, SoftBank's WeWork losses alone exceeded the entire market capitalization of most publicly traded companies. The Vision Fund, which had been launched with $100 billion, would never fully recover from the loss. The write-down sent shockwaves through the venture capital industry. If SoftBank could lose $9.2 billion on a single investment, no startup valuation was safe. The era of growth at any cost was over. The COVID-19 pandemic hit in March 2020, just as WeWork was trying to restructure under new leadership. The timing could not have been worse. Millions of people began working from home. Companies that had been WeWork members suddenly realized they did not need office space at all. The co-working business model, which depended on companies renting desks for their employees, was suddenly obsolete. The pandemic did not just accelerate WeWork's decline. It revealed that the entire premise of the business, that companies would always need physical office space, was a bet that could be broken overnight by forces no one could control. WeWork's occupancy rates, which had already been declining, collapsed. Some buildings went from 90% occupancy to 15% within weeks. Members who had signed month-to-month contracts canceled en masse. The company had no floor on its revenue. It could go to zero. But it had a floor on its costs. The 15-year leases it had signed with landlords. WeWork was now in a nightmare scenario. It was paying billions of dollars in rent for buildings that were almost empty. Every empty desk represented a negative cash flow that could not be stopped. The pandemic exposed the fundamental fragility of the WeWork model. In good times, it barely worked. In bad times, it was catastrophic. The financial deterioration during 2020 was staggering. In the second quarter alone, WeWork's revenue dropped 10% from the prior quarter, and the company burned through $670 million in cash. Occupancy rates fell to their lowest levels since the company was a startup operating out of a single Brooklyn warehouse. The company tried to stem the bleeding by cutting costs. It slashed capital expenditures by 80%, laid off thousands of employees, and closed more than 100 underperforming locations. But the cost structure was too rigid. The leases were the problem, and the leases could not be easily broken. WeWork had built its empire on the assumption that demand for flexible office space would only grow. COVID proved that demand could evaporate overnight. And when it did, WeWork had no plan B. The company that had been called a technology platform, a community movement, an elevator of the world's consciousness, turned out to be exactly what it had always been: a real estate company with too much debt and too little cash. And in a pandemic, real estate companies with too much debt do not survive without radical restructuring. The company had 777 locations in 39 countries at its peak. By mid-2020, many of those locations were empty. WeWork began a desperate campaign to renegotiate its leases. It vacated 66 locations entirely. It renegotiated terms at more than 150 others. It asked landlords to accept lower rent, shorter terms, or both. Some landlords agreed because they had no choice. Finding a new tenant for a 200,000 square foot office space was nearly impossible in the post-pandemic commercial real estate market. Others sued, arguing that WeWork was in breach of contract. The company was losing on both sides. It was bleeding cash on empty buildings while paying legal fees to fight the landlords it was abandoning. The situation was a classic tragedy of the commons. Every party was acting in its own self-interest, and the result was destruction for all. In October 2021, WeWork went public through a merger with a special purpose acquisition company, a SPAC, at a valuation of $9 billion. The SPAC was backed by Boex Acquisition Corp. The merger gave WeWork access to $1.3 billion in new capital. But the valuation was a fraction of what it had been 2 years earlier, and the company was still losing money. The SPAC merger was not a sign of recovery. It was a lifeline thrown to a drowning company. SPACs had become the preferred vehicle for companies that could not go public through a traditional IPO, and WeWork fit the pattern perfectly: high name recognition, terrible financials, and a desperate need for cash. By 2023, the losses had not stopped. WeWork was paying over 80% of its revenue on rent and interest, more than $2.7 billion annually. Its debt had grown to unsustainable levels. In May 2023, the company exchanged old debt for new debt with interest rates as high as 15%, meaning it was paying a penalty for its own risk that would make it even harder to become profitable. The company was trapped in a debt spiral that had only one possible end. The SPAC merger, which had been presented as a fresh start, had instead delayed the inevitable. The $1.3 billion raised in the merger had been consumed within 18 months, burned through by the same structural losses that had plagued the company from the beginning. The new management team, led by CEO Sandeep Mathrani, had attempted to cut costs aggressively, renegotiating leases, closing locations, reducing headcount, but the fundamental mismatch between long-term lease obligations and short-term member contracts remained. The company's market capitalization fell from $9 billion at the time of the SPAC merger to under $100 million by mid-2023. The stock, which had traded above $10 per share after the merger, fell below 50 cents. The company received a delisting warning from the New York Stock Exchange. The situation had gone from dire to terminal, and on November 6, 2023, a date that would make the collapse official, WeWork did what everyone had been expecting for years. It filed for bankruptcy. On November 6, 2023, exactly 4 years after the S-1 filing that began the collapse, WeWork filed for Chapter 11 bankruptcy protection in the United States District Court for the District of New Jersey. The company listed liabilities between $10 billion and $50 billion. It was one of the largest real estate bankruptcies in American history, second only to the 2008 financial crisis. The bankruptcy filing allowed WeWork to reject leases on underperforming locations, effectively walking away from billions of dollars in rent obligations. Landlords who had signed 15-year leases with WeWork, believing the company was backed by SoftBank's billions, were left holding empty buildings. Some of those buildings were in prime locations in major cities. Some were new developments built specifically for WeWork. The ripple effects across the commercial real estate market were enormous. WeWork's bankruptcy did not just destroy a company, it destabilized an entire asset class. Office buildings that had been valued based on WeWork's guaranteed rent were suddenly worth fractions of their previous valuations. The damage spread far beyond WeWork itself. In 2024, WeWork emerged from bankruptcy. A company called coup, an affiliate of Yardi Systems, a real estate software company, acquired a 60% stake. SoftBank retained 20%. Other investors received the remaining 20%. The company now operates approximately 154 locations in 35 countries. At its peak, it had 777 locations in 39 countries. The empire was reduced by 80%. The company that was supposed to change the way the world worked now operates about a fifth of its former footprint. The headquarters, once a sprawling campus housing the future of work, was reduced to a single floor in a nondescript office building. The revolution had been downsized. Adam Neumann, sitting on his $1.7 billion, watched from the sidelines. He called the bankruptcy filing disappointing. He did not offer to return any of the money. He did not apologize to the employees who lost their jobs, to the landlords who lost their tenants, to the investors who lost their capital. He simply moved on to his next venture, a company called Flow, a residential real estate platform. It was WeWork for apartments. And he had already raised $350 million from Andreessen Horowitz. The man who had destroyed $40 billion in value was back raising money for the same model, and investors were writing checks. This is the most disturbing part of the WeWork story. The system that created Neumann has no learning mechanism. The same venture capital machine that funded his rise is now funding his second act. Flow, Neumann's new company, is worth examining because it reveals how little the venture capital industry learned from the WeWork disaster. Andreessen Horowitz, one of the most respected venture capital firms in Silicon Valley, the firm that backed Facebook, Airbnb, and Coinbase, wrote a $315 million check to Adam Neumann in 2022 for a company that had, at the time, no product, no revenue, and no disclosed business model beyond the vague concept of reinventing residential real estate. The investment was the largest single check Andreessen Horowitz had ever written to an individual founder. Mark Andreessen, the firm's co-founder, published a blog post explaining the investment. He wrote that Neumann was a visionary founder who had revolutionized the commercial real estate industry, and that he would do the same for residential real estate. The blog post did not mention the $47 billion valuation collapse, the governance failures, the related party transactions, or the $1.7 billion exit package. It did not mention that WeWork had just filed for bankruptcy. It simply presented Neumann as a genius, the same story that had convinced SoftBank to invest $10 billion. The cycle was repeating itself, almost verbatim, and the most remarkable part is that nobody seemed surprised. In Silicon Valley, failure is not a disqualification. It is a credential. And Adam Neumann had failed bigger than almost anyone. SoftBank learned a painful lesson. Masayoshi Son had bet $10 billion on a founder because he liked his energy. He had ignored the numbers because the story was compelling. He had waived due diligence because the relationship felt right, and he had lost almost all of it. In 2020, SoftBank reported an annual loss of $12.7 billion, the largest in Japanese corporate history. WeWork was the primary cause. Son, who had been celebrated as a visionary, was suddenly being questioned by his investors, his board, and the public markets. The Vision Fund had to scale back dramatically. The disaster did not destroy just WeWork. It damaged SoftBank's entire portfolio. The human cost was devastating. WeWork laid off 400 employees, nearly 20% of its workforce. The layoffs were announced via email. Employees who had been told WeWork was a family found themselves locked out of their accounts with no warning. The community they had been promised turned out to be a company, and companies, when they fail, do not care about community. When the narrative collapses, the people who believed in it are the last to know. The ones who paid the price were not the executives who approved the spending or the investors who ignored the warnings. It was the employees who believed in the mission and showed up every day to build it. The stories from former employees are revealing. Many had turned down higher-paying jobs at established companies to join WeWork because they believed in the mission, the idea that they were changing how the world works. They had worked long hours, attended summer camp, chanted the company's slogans, and drank the free beer at the weekly happy hours. They had accepted stock options that were supposed to make them wealthy when the company went public. Those options became worthless when the IPO collapsed and the company's valuation cratered. Some employees had taken out loans against their expected stock wealth, loans they could not repay when the stock never materialized. The cult-like culture that Neumann had built, with its promises of community and transformation, had extracted years of loyalty and labor from thousands of people who, in the end, received nothing in return. The founder walked away with $1.7 billion. The employees who built the company walked away with a severance package measured in weeks. The disparity was not a bug in the system. It was the system working exactly as designed. So what did we learn from WeWork? There are 3 lessons, and they apply to every company that tries to tell a better story than its numbers support. First, revenue is not profit. WeWork had nearly $2 billion in revenue. It also had $2 billion in losses. Revenue is how much money flows through your business. Profit is what you keep after paying your bills. WeWork confused the two, and many of its investors confused them too. When they saw $2 billion in revenue, they assumed it meant something. It did not. The business was structurally unprofitable at its core. The more locations it opened, the more money it lost. Growth was not the path to profitability. It was the path to larger losses. This is a lesson that every generation of investors has to learn for itself, and it is a lesson that we keep forgetting. The dot-com bubble taught us that revenue without profit is worthless. The 2008 financial crisis taught us that leverage without capital is dangerous. And WeWork taught us that growth without a working business model is just an expensive lesson waiting to happen. But each time, we convince ourselves that this new generation of companies is different, that the rules have changed and old metrics no longer apply. They always apply. They applied in 1999, they applied in 2008, and they applied in 2019. Revenue is not profit, and it never will be. Second, the CEO is not the company. Adam Neumann was a charismatic founder with a compelling personal story. He built a culture of loyalty and excitement. But he also built a culture of fear and excess. He was the company's greatest asset and its greatest liability. When investors invested in WeWork, they were investing in Neumann. And when Neumann's weaknesses became impossible to ignore, they had no fallback position. The company and the CEO were the same thing. And when the CEO failed, the company failed with him. This is why governance matters. This is why independent boards matter. This is why you never let one person control everything. The entire WeWork disaster could have been prevented by a single independent director who said no. But the investors who put Neumann in charge of everything were the same investors who enabled his excess. They created the monster, and then they were surprised when it turned on them. Third, and this is the most uncomfortable lesson, SoftBank was not the victim in this story. SoftBank was the enabler. The $10 billion bet was not made by a naive investor tricked by a charismatic founder. It was made by a sophisticated institution that chose to ignore red flags because the potential returns justified the risk. Masayoshi Son knew about the governance problems. He knew about the related party transactions. He knew about the losses. And he invested anyway because he believed momentum could overcome any obstacle. Every investor in WeWork, from SoftBank to Fidelity to JP Morgan, had access to the same information that would eventually bring the company down. They chose not to look. They chose not to ask. They chose to believe the story because the story was profitable until it was not. There is a fourth lesson, and it is the one that applies most broadly. Markets are not always efficient. The efficient market hypothesis, the idea that asset prices reflect all available information, is one of the foundational theories of modern finance. According to this theory, it should be impossible for a company to be valued at $47 billion when its own financial disclosures show a structural imbalance of $43 billion between obligations and revenue. And yet, that is exactly what happened. WeWork's valuations were set not by an efficient market processing available information, but by private investors making emotional decisions based on a compelling narrative. The private market, unlike the public market, has no mechanism for price discovery. There is no short selling. There are no independent analysts publishing skeptical research. There is no daily voting mechanism where thousands of investors express their views through buying and selling. In the private market, the price is whatever the last investor paid, multiplied by the number of shares. The WeWork disaster is, among other things, a refutation of the idea that private markets are inherently more rational than public ones. They are not. They are merely less transparent, and in the absence of transparency, narratives, not numbers, determine value. The public market exposed what the private market had been hiding. That is, in fact, the entire purpose of the SEC and the S1 disclosure process. WeWork proved that the process works, but only after the damage has been done. The strange irony is that SoftBank's other massive bets, Uber, DoorDash, Alibaba, have been enormously successful. Son's batting average as an investor is still well above average. But the WeWork loss was so large that it overshadowed everything else. It was a reminder that in venture capital, a single catastrophic failure can wipe out the gains from a dozen moderate successes. This is the fundamental risk of the SoftBank model. When you bet billions on individual founders, you are betting that they will not turn out to be Adam Neumann. And the uncomfortable truth is that for every successful founder who justifies the bet, there is a Neumann waiting to happen. The system is designed to produce both outcomes. The winners make the headlines. The losers make the case studies. WeWork is one of the most expensive case studies ever written. The WeWork building at 115 18th Street NW in Washington, D.C., one of the company's flagship locations, was sold in 2024. The new owner converted it into a traditional office building. The We signs were taken down. The exposed brick was painted over. The community was replaced by tenants who signed standard 5-year leases. The building is fully occupied today. The revolution that WeWork promised, the transformation of how the world works, turned out to be a short-term rental business with really good marketing. The emperor had no clothes, but for a few years, nobody wanted to say it because the story was too profitable. WeWork was not a fraud. It was not a Theranos-scale deception. It was a legitimate business with a real product. People wanted flexible office space, and WeWork provided it. The problem was not the product. The problem was the valuation. The company was a good real estate business that was priced as a great technology platform. When the market realized the difference, the valuation collapsed. But the lesson is deeper than that. WeWork's collapse was a warning about a venture capital system that rewards founders for storytelling, that prioritizes growth over profitability, and that creates billion-dollar valuations for companies that have never earned $1 of profit. That system has not changed. The next WeWork is already being funded. The next charismatic founder is already telling a better story than their numbers support. And the next SoftBank is already writing a check. The question is whether we will see it coming this time. History suggests we probably will not. But at least this time, we have the story of WeWork as a warning. Whether anyone will heed it is a different question entirely. The WeWork story is not unique. It belongs to a long tradition of speculative manias that extends back centuries. In the 1630s, Dutch investors bid up the price of tulip bulbs to the equivalent of a skilled craftsman's annual salary before the market collapsed and left speculators holding worthless bulbs. In the 1720s, the South Sea Company convinced British investors to pour their savings into a company whose actual business was barely profitable, triggering a crash that ruined thousands. In the 1840s, British investors poured money into railway schemes that would never be built, driven by the belief that railways were the future, which they were, but the future took longer to arrive than the investors' patience. In the 1990s, dot-com companies with no revenue went public at billion-dollar valuations on the promise that the internet would change everything, which it did, but not soon enough to save the investors who bought at the peak. Each generation produces its own version of the same story, a transformative technology or idea, a charismatic promoter, a wave of speculative investment, and a crash that leaves ordinary people holding the losses while the promoters walk away rich. WeWork was the 21st century version of this ancient tale, updated for the age of venture capital and sovereign wealth funds, but otherwise unchanged in its essential elements. The technology changes. The industries change. The names change. But human nature, our willingness to believe a good story, our tendency to follow the crowd, our inability to learn from history, remains stubbornly, tragically the same. And that, perhaps, is the most important lesson of all.